As digital money becomes a reality, governments must be ready to embrace it. That is because the technology may transform the payments, financial and economic landscape. Moody's expects central bank digital currencies and tokenized deposits to increase, but to have limited impact on the share of payments made with cash. They can help connect underbanked populations to the financial system. 1. Stablecoins. Stablecoins are a subset of the cryptocurrency market that seek to provide price stability. They are typically pegged to pre-existing fiat currencies, exchange-traded commodities, or other cryptocurrencies. This reduces their volatility relative to speculative cryptocurrencies, and enables them to serve as a store of value, medium of exchange, and settlement asset in the crypto ecosystem. In practice, stablecoins face a range of risks, depending on their design and use case. For example, many of the largest stablecoins are not fully backed by high-quality liquid assets, and thus are exposed to credit risk. Herman's et al. 2021. Furthermore, many of these stablecoins invest a portion of their reserves in risky or illiquid assets and hold only a thin capital buffer to cover potential losses on these investments, which may leave them vulnerable to a run. Moreover, the rapid growth of stablecoins in recent years has led to calls for tighter regulation of the industry, including bank-like regulations, Adaki et al. 2021. The risk profiles of payment stablecoins, which are generally intended to be used as money, also depend on their design and scope. For example, many current payment stablecoins rely on energy-intensive proof-of-work consensus mechanisms that involve so-called miners competing to solve complex cryptographic problems. As such, these stablecoins can be susceptible to security vulnerabilities and the risk of user loss, CFR et al. 2021. By contrast, some payment stablecoins use algorithmic methods to maintain their peg to a reference currency. In these cases, smart contracts execute to manipulate the circulating supply in order to keep the price steady. In this way, they may be more resilient to security threats and are less susceptible to a run on their reserves. Other stablecoins are designed to track a basket of fiat currencies, which can offer investors and users reduced exposure to a single country's monetary policy. Herman's et al. 2031. In this sense, they may be more reminiscent of private monies issued during the free banking era in the United States. These types of stablecoins can be a useful tool for businesses that want to reduce their exposure to fluctuations in foreign exchange rates. 2. Cryptocurrencies. Cryptocurrency is a digital representation of money that uses blockchain technology to facilitate transactions and make them more secure. This technology eliminates the need for third parties in a transaction, and it allows for features such as blind signatures, zero-knowledge proofs, and encryption to add security. Cryptocurrencies can also be used to make payments that are virtually untraceable and anonymous. The cryptocurrency market has exploded in recent years. As more companies use these assets, the value of cryptocurrencies could continue to rise. However, it is important to note that the value of cryptocurrencies can fluctuate, and it is possible to lose money on crypto investments. Therefore, it is essential to research the market before investing in this type of investment. Despite the fluctuating value, many people believe that cryptocurrency is here to stay. This is partly because it has shifted the way people think about money. For example, some consumers use cryptocurrencies to invest in projects or start new businesses, while others simply want to buy the coins and hope that they will increase in value. In addition, some cryptocurrencies have fixed values and are called stable coins. These are meant to protect against the volatility of the underlying asset, and they can offer investors a sense of stability. Finally, the cryptocurrency market has become a target for criminals. For example, it has been used to evade sanctions and fund terrorist groups. As a result, it is important to understand the risks and regulations involved in this area before investing in it. A significant question remains about how governments will regulate cryptocurrencies. For example, it is unclear how the Securities and Exchange Commission will treat this new asset class. The answer to this question will have major implications for the future of cryptocurrencies. Despite the challenges, it is clear that cryptocurrencies have changed the world of finance. The technology has shattered convention and created a revolution that threatens the very foundations of traditional finance. This is a major opportunity for entrepreneurs, and it is likely that the future of money will be defined by this technology. 3. Tokenized deposits. As central banks and commercial banks ponder the future of money in the digital economy, the idea of tokenizing existing deposits has been gaining traction. Tokenized deposits would take a bank's deposit claims, or tokens, and put them on a blockchain network to enable instant and secure transfer of funds. Banks could offer these tokenized deposits directly to their customers as well as on a crypto exchange, DEX, that enables parties to trade the deposit tokens without a middleman. These tokenized deposits could be used for both domestic and cross-border payments as well as trading and settlement. They could also be redeemed back to the issuing bank or converted to traditional fiat. Tokenized deposits are similar to stablecoins in that they can be purchased and sold on a cryptocurrency market, but are backed by actual banking assets and are able to meet regulatory requirements for stability. Because the blockchain provides a permanent record, these transactions are highly transparent and eliminate any risk of breaking the buck. The use of smart contracts can also automate certain aspects of the tokenized deposit, making it more functional. Tokenized deposits are a promising alternative to stablecoins and CBDCs, because they can be offered by banks that are already familiar with the regulatory frameworks in place. Additionally, tokenized deposits are backed by the trust of the bank and can be transferred instantly around the world. They are also more likely to be accepted in a variety of markets, as opposed to stablecoins, which are typically limited to specific niches. Finally, a tokenized deposit can be used for the same purposes as fiat cash, including lending, making it a potential competitor to consumer credit cards and other forms of traditional debt financing. As the technology continues to evolve, it's worth keeping an eye on the emergence of new entrants in the market, such as the blockchain-based USDF project being developed by the Federal Reserve and 9 banks. While the underlying tech for digital currencies continues to evolve, there is still a lot of debate over what they will look like in the future and who will offer them. Stablecoins are currently leading the way, but they may face stiff competition from central bank digital currency or deposit tokens in the near future. 4. Central bank digital currency. The digital revolution is changing the future of money. It is transforming how people and companies buy and sell goods and services, including bringing broad and inexpensive access to financial services to 1.7 billion people without traditional bank accounts. It is also enabling countries to grow more connected and facilitating trade and market integration. But it is not a smooth and risk-free transition. It opens the door to fragmentation, currency substitution, and loss of policy effectiveness. It is therefore critical that governments manage the development of these new technologies carefully to ensure that they serve the interests of all. A CBDC would allow customers to hold, transfer, and spend their own national currency directly, eliminating the middlemen who currently handle bank transfers and payments. It is a potential complement to existing forms of payment, such as credit cards and mobile phone apps. Proponents of CBDC say it will bring lower transaction costs, greater transparency, and faster payments to individuals and businesses. They also argue that it will help prevent the fragmentation of the payments landscape into CBDCs, stablecoins and private crypto assets, as the World Economic Forum's central bank digital currency global interoperability principles state. This fragmentation has the potential to reduce liquidity, exacerbate capital outflows and threaten global financial stability. To succeed, CBDCs will require a new generation of tools, skills and talent. This includes a change in decision-making processes and new approaches to collaboration. It will also require a strong commitment to data protection and cybersecurity. Finally, it will require new technology infrastructure to enable secure and interoperable transactions. It is too early to tell what the full impact of a cashless society will be. But it is clear that this is a major trend with far-reaching implications for the economy, society, and our way of life. We are in the midst of a significant shift in how we pay for everything from food to housing to healthcare. And it will likely continue to accelerate as we move further into the digital era.